Hey, everybody, good morning. Happy Wednesday. Hope everyone had a great Easter, feeling refreshed. If you're on your Easter holiday and need a break between playing with kids and going out, maybe I can give you a little breather if you want to look at some long term market trends. Very exciting. Crazy things obviously happening in the U.S. political scene, as always. I think that's just going to continue. But to sort of put things in perspective, like I try to do, let's look at some broad brushes here with the economy. Okay, so everybody's trying to figure this out. Trump says he's maybe backing off the tariffs. Of course, look at that iBit ad right here. This is just on Politico.com. Getting my browsing history, of course. Everybody's trying to figure out what's going on here. Okay, S&P choppy, obviously choppy to down over the last 6 months, but every little update, Trump is going to say that he saved the day, even though obviously from his call with Vladimir Putin to Liberation Day, markets aren't necessarily liking what he's putting out there. Okay, so as I do, let's try to look a little bit more long term here, figure out what's happening. We're going to look at a bunch of different markets: bonds, stocks, gold, Bitcoin, even monetary policy, that is the Fed's balance sheet, and see what we can see. The main thing here, this is the S&P 500 annual return. Okay, so not the index itself, but annual return, rolling. Let's count the cycles. Okay, so this is about 75 years worth of data. It goes back to 1950. Let's count the full cycle, either peak to peak or trough to trough. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Here's 13, kind of a long one. Goes down a little bit. Let's just call this 13. 14, kind of a long one. 15. And here it gets a little bit weird, but let's just say this is, we can count it, whatever. 16, 17, 18, 19. Something like 1920 peaks and troughs over 75 years. What does that mean? Roughly, okay, it's a little bit more than every 3 years. You got another peak. Of course, you have, not always as pronounced peaks. Here you kind of rolling along for a decade. 90s kind of going up, right? Especially from 95. Stock market really goes up and then crashes. .com. But basically every 3 to 4 years, very roughly, you got another peak in the S&P 500. Right away, this chart is for traders, okay? This is for traders. If you buy anywhere on this curve and hold long enough, your compound return is going to be something like 7%. Okay, if you reinvest those dividends, it's going to be something like 9%. Okay. When I say anywhere, I should say like a longer term, like you hold 3 decades, something like that, long time, an investable lifetime. Okay, so all these crazy peaks, troughs, Maylocks moments where you can be 30% up or 43% down year on year. This is the stagflation period of the 70s, petrodollar coming into effect here. Obviously, the GFC, one of the worst since the Depression, 45%. Okay, S&P went to 666 in March 2009. And then huge booms after the money prints, I'll show that in a second. But bottom line is 7 to 9% if you reinvest those dividends. Here, if you caught the worst of the global financial crisis and then held on, you'd be above 10%. So 10, 11, 12%. Reinvest those dividends, it's even more. Okay, usually the dividend will give you a 2% juicer if you keep reinvesting them. But that's the That's the stock market in the United States. Okay, long term. I'm hardly a fan of Trump's policies on many areas. Probably with most of America. Again, I'm speaking as a American living in Europe, but I'm probably with most of America that immigration is a bit out of control in the last decade. So I think he's trying to work on that. But obviously, if you're going to test the Constitution, you're going to have some pushback there. So there's a lot to untangle there. But then on top of that, you have the sort of the 1-2 punch. You have the tariff game that Trump is trying to play, and a lot of people aren't playing. All right, most notably China. So Trump's maybe backing off that. We'll see. So where do we go right now on an annualized basis? Let's zoom it in. We're still up about 6% year on year. Interesting, right? This, by the way, coincided with Bitcoin. We're going to get there. But we were down, 19, 20% year on year at the end of 2022, okay, from a great 2021, again, coinciding with the meme stocks, the money printing, Bitcoin as well. We'll get to Bitcoin later. But still, right now, up 6% year on year. So the question is this going to go down to, minus 10, minus 24, like it did in 2002, 40? It's going to go down 45%. Market's trying to price that in. Trump certainly doesn't want to do that because everything he's doing at this point looks completely self-inflicted, and his poll numbers are falling like a rock, which is the most important thing he cares about, or what people thinks about him. Point is, swing trading might be an option. All right, I'm a fan of that. When there's blood in the streets, if you want to make the best return out of this, like I said, let's just call it 7 to 9%. That's the long term. Without dividends, 7%, 9% with dividends. Yes, if you buy the troughs, it's more, but 7 to 9%. If you want to beat that, like I said, you really buy these deep discounted troughs. All right. Just like the Rothschilds said, when there's blood in the streets, that's the time to buy. Okay, so I actually think if you want to trade stocks or swing trade stocks, sort of more midterm, you should crave bear markets, especially if you're young and you have a lot of time to make it back. Okay. But this is not only going to be about stocks. I want to talk about Bitcoin. I want to talk about gold. We're going to look at a lot of things. All right. Everything's going to be on a yearly return, okay? With bonds, with stocks, everything's going to be on a yearly basis, okay? So that's what this is. Now let's look at the change in the Fed balance sheet. Change in the Fed balance sheet. Still going to be on the right-hand axis here, trailing 12-month percentage. I'm going to put the Fed balance sheet on right now. Okay, so this is monetary policy. Let's go before the GFC. Monetary policy was, when they were trying to figure it out, right? Because the Fed, they never like to say that what they did during the Great Depression, and they did contribute to low interest rates during the Roaring '20s and the lead up to the Great Depression, but they like to say that's practice. This is when they sort of had their feet fully under them, understood what was going on. It didn't take much to swing markets, okay? There's different reasons why they might take the balance sheet down here, okay, or up, which happened for sure in the global financial crisis. It also happened here during the dot-com boom and bust. This is when the New York Times went to call Alan Greenspan the maestro because he's increasing the money supply. He's increasing the money supply as the markets are falling. But it's light touch, actually. You don't have to do much. To be a banker is quite nice during these decades. The great moderation. It seems volatile, it seems choppy, but the Fed would only have to move its balance sheet, let's just say a fraction of whatever was happening in the markets, to have an effect. And that's not the only reason, of course. There's just normal cyclicality in the markets. There's normal leveraging and deleveraging in the markets. There's normal risk on, risk off trades in the markets. So I'm not saying that what the Fed balance sheet does, markets will respond. But it's just interesting to see that it doesn't take much here, tinkering, before the global financial crisis. After the maestro left and Ben Bernanke had to come in, we get this period. All right. Deep discounts, deep destruction, and massive monetization. All right. This increase in the Fed balance sheet is basically, it's not the exact, remember, I do the monetary base stuff in detail. This is just total Fed balance sheet. So it's mostly the monetary base, but there's a little bit more happening there too, but it's mostly the printing press. Massive money print, QE 1, 2, 3. This is actually QE 1, 2, and 3. QE 1 was the biggest percent change because we were going from under $1 trillion balance sheet to a couple trillion. All right, so over 100% run rate per year. Brought the markets back already by 2010. Then people got worried again, another QE and another QE here. But a lower percentage. Only about 24% increase in the balance sheet, or 40% here. 3 QEs, 3 money prints. And then, of course, COVID. And notice, by the way, here, I talk about this a lot in Bitcoin. And think about Bitcoin is happening during this period, okay? Bitcoin is already derived, Genesis block, all the stuff is born out of the financial crisis. Of course, the cypherpunks were talking about this for decades before. But the money print was done by 2014. And if you were a Bitcoiner saying that all the central bank knows how to do is print in this period, from 2013 to 2019, you'd actually be wrong. They were not printing. Money supply was at 0 or going down. Okay. What I absolutely would agree with people who are against central planning of the money supply is they don't know when to stop. Okay, so what they're trying to do from this period of mid-2014 to September 2019 is get back to some sort of normalization of the balance sheet. All right, because the balance sheet was approaching $6 trillion here. Didn't get there, I believe. And it was coming down. So we're trying to approach normalization. But the markets weren't accepting that. They had the repo spike here, the market for short-term Fed funds between banks and non-banks, money market funds. So they had to print money here, and then COVID. All right, then the destruction of the markets again. You see the markets go down. Actually not as bad as on a trailing 12-month basis than it ever was during the GFC, minus 15%. But the immediate response, okay, doubling, tripling of the balance sheet, and they almost get to 9 trillion. 9 trillion in value of the central bank balance sheet here, and then down again. And it's interesting that when they, the Jackson Hole speech is actually here, summer of 2022, I believe. Yeah, talking about how they're going to continue to try to normalize again, but from the immediate normalization here in 2021, markets actually jumped up, which was interesting. Okay, but regardless, the point is they're still trying to normalize, still trying to drop the balance sheet on a trailing 12-month basis, and now we're down 9% year on year for the Fed balance sheet. Okay, so the point is, central banking was very pleasant. Even here, even during the high interest rates of Volcker moving up to the 80s here, Okay. He was doing a lot of different things, taking the balance sheet up, down, up, down. Interest rates were peaking right about here. They didn't have to move the balance sheet much. Here, they bailed out everybody. And this was a big mistake. Bailing out everybody was a big mistake. Okay. There's going to be too many lines here if I start to do too much, but the central banking story I think is pretty clear, especially on my channel, tracking this stuff. So I'm going to take the central bank movements off. All right, just go back to the S&P. Now let's look at the change in the 10-year. And when I say the change in the 10-year, it's not actually the change in the yield. It's just the yield itself, because the yield is an annualized return that you expect to get at any given time. Okay, so here's the 10-year yield here. All right, so this yield is on the left-hand axis. The blue, the S&P 500, is on the right-hand axis. My color is actually a little bit hard to see. Apologies, but here's the Volcker. You know, the notes, the midterm to long-term yields of the U.S. get up 15, 16%. Short-term actually got to 20%. Let me take the S&P off, all right, just to see the yields. We've shown this before, but you can see two distinct trends here. One is after gold was fully untethered from the dollar, there was inflation, there was rising unemployment. The 70s were a tough period, but also the U.S. struck a deal with the Saudis for the petrodollar, and Volcker helped push these interest rates to all-time highs to prick the inflation bubble, the price inflation bubble during this period. But really, it's just two trends, right? It's one up and then huge bull for the next 40 years. And remember, when yields go down, the price of bonds go up. So if you were owning bonds right here for the 10-year note, you could sell it at any point here while the yield goes down, and you could make a profit beyond this 14% yield. Okay. Calculating that exact profit with bonds is a little bit difficult because every bond is a new deal. It's hard to do an exact calculation here, but if someone would really look at a 10-year bond here in 1980 and then look at another 10-year bond in 1985, all right, and so it's roughly half of the yield. Okay, so that roughly means that you doubled in price. It's not exactly that way because you also lose 5 years of coupon payments. Like if you tried to sell your 10-year bond here that you bought in 1980, you tried to sell it in 1985, you wouldn't get double because you've already lost 5 years of coupon payments, but you get a lot. You'd get a big return. So that's how bonds work if you buy and sell. All right. So point is, once Paul Volcker set Alan Greenspan up for this Greenspan put activity, it was very easy for Greenspan to just, anytime there was a blip in the market, you just drop interest rates. And he did that particularly well right here after the .com, a huge, pets.com, huge boom and bust. All right, so let's put the trailing 12-month in and just see a couple interesting things here. Okay, so when the yield of a bond rises, that means the price falls. Okay, so the price of bonds were falling here. Stocks were also falling here. Okay. But then here, we start to see we get set up to that nice 40-year bull. So now the stock market is going up, and bonds are actually also going up. The yield is falling. Oh, sorry. Yes, they are growing up. That when the yield falls, the price goes up. Right, inversely related. And we just have this nice sort of easy thing here where if the markets get too hot, the central bank is completely in control of the 10-year, but when the markets get too hot or, as they say, need to cool off, you can raise interest rates. Markets go back down. Then the markets are too low. So now you need to lower interest rates. The black line goes lower. Markets go back up again. And you just sort of rinse and repeat. This happened very notably here. Huge peak. All right, we're up year on year 30, 40% in the S&P 500. NASDAQ was well more. Markets start to fall. 10-year is 5%. And 10-year is actually not the best place to show it. Let's put on the 2-year now. Okay, here we go, the 2-year. This is better. Fed has more control over the 2-year than the 10-year. Actually, the 2-year is, I need to put the Fed funds on as well because that would show the divergence even better. It's interesting that the 2-year is rising back here, but of course, here's the fall in the markets. This is actually already waypost.com, sorry. So here's the fall in the markets. And this fall in the 2-year as well, bailing out the markets. A nice Greenspan put. This is the fall from .com, of course, in the 2000s. All the way down here, the nadir was somewhere 2003. So this is why the New York Times called Greenspan the maestro. And the Fed funds dropped even further, faster than that. And then they know that there's inflation, all right, from their repumping of money. So short-term rates rise, but they never know when it's enough, when they need to let off the gas. And then another crisis happens again. Of course, none of this is in a vacuum. There's other stuff happening. We have, obviously, the mortgage-backed security debacle and the bailout of money printing there. But, you see the 2-year now. Whoops. Sorry. The 2-year starts to look a lot like the Fed funds, and we're going to historical lows here. Okay, rounding to 0%. It's not 0%, it's just rounding. I should have put that at a tenth so you can see it. But rounding to 0% here as the QEs are happening for the 2-year. And then they try to normalize it here, back to that COVID stuff. And then once COVID happens, they just blow the lid off the money printer again. Okay, so again, very abnormal stuff starts to happen post GFC. You can see it with the Fed balance sheet, all right, going to 100, 200% year on year, 80% year on year, and you can see it with historically low interest rates. Let's take off the Fed balance sheet. Let's look at the 10-year. Let's take off the S&P now just to show another interesting thing. We can look at the 10 and the 2. This is sort of a typical bellwether of the yield curve. Okay, so the 10-year is on the longer end, not the longest. We have the 30-year bond in the U.S., but it's on the longer end. And usually the 10-year minus the 2-year, when you see an inversion, that's a really problematic economy. Okay, so now I'm going to put the spread here. All right, so I don't have an axis, but the 0 is right there. Okay, 0. And when you see this green line go negative, almost always it predicts a recession or a drop in the markets. Okay, so it happened here. Happened a little bit here in 89. And it happened here in 2000. I need to do this to 0.1%. Sorry, -0, but it's going negative. So that got the .com, and it just went a little bit negative here as well in May 2007, global financial crisis. It happened again in 2019. I'm not sure if I'm picking it up. Maybe it didn't. Just very briefly. Yeah, in August 2019, interesting, COVID happened again. So, of course, news was coming out here. Very sparse news was coming out from China. And it went negative. And then it went negative here in 2023. And this was an interesting one because let's put the S&P 500 back up. S&P actually, this is one where it did not really get it, at least in the midterm. So the S&P was rising all the way from, it was falling a lot from 2021, but it started to rise again. And we went inverted again on the yield curve. And when I say not just inverted, but below zero. The 10 to 2 year spread, and the markets still go up. So that was, again, one, it's not always correct. And now we're not as far inverted again. So we're again, somewhat normal. The black line, when the black line is above the dotted line, the 1 and the 2, the 1 is the 10 year, the 2 is the 2 year, you don't have an inverted curve. Again, it starts to look like mad scientists. I know a lot of this stuff, but I'm still trying to get to the long term, and we're trying to get to Bitcoin. All right, everything is annual on this chart. Okay, so let's take off the spread. Let's take off yields. Let's go back to the S&P. Let's look at gold. Both of these are on the right-hand axis. Gold started to become untethered here at the end of the 60s. Charles de Gaulle was claiming it back from the United States. There's a lot of interesting quotes that you can find from this period from economists. A lot of economists thought gold would go down in price. They were obviously wrong, way wrong. And in fact, since somewhere here, it hasn't been, in the tens of dollars ever again. It went over $100 per ounce, whatever, somewhere here. And then this is $850 an ounce for about 2 seconds, okay? 258% year-on-year return. But this also coincided with Volcker really extending those interest rates to high levels. And, pricking the gold bubble. But it was interesting, and I think not a lot of people foresaw it at all, in that the dollar still remained the dominant asset. And there was no tie to gold anymore, really, for the first time in history. There's no currency backing here during this period. It was a rough period. Gold bugs thought that they were in paradise, but that stopped. The dollar hegemony remained. The Triffin dilemma came into effect. The dollar milkshake theory, as Jeff Snyder says, where countries still preferred dollars. They had gold too, but they were always actually shedding reserves from like the 60s down to 2008, and they started to add from 2008. That's a very slow-moving aircraft carrier type of a movement. So they would still have gold, but they would also have dollars. Central banks would have dollars as their reserves. A huge, still to this day, 50% of international reserves of central banks are in dollars or dollar-denominated assets, like treasuries. And that wasn't necessarily clear here at the beginning. Remember, it was a temporary closing of the gold window by Nixon. So it wasn't necessarily clear, but the U.S. got away with it, basically, and the U.S. had the dollar supremacy. So the question is, and you can see that dollar supremacy here in the 10-year. Okay, so remember, a falling yield is a rising price in the bond. So you could buy the bonds anywhere here, 10, 15, 20%, and you'd be golden for the next, 40 years. Of course, these were only 10-year notes. It's the same trend with a 30-year note, but you could just you could bond ladder in, buying more and more 10 years, and even as it, yield may not be exactly the same a couple years later, but you just buy more, and as that trend goes down, that it's called yield compression. You're just richer and richer, basically. I want to make that clear because that's not always clear for people with bonds. Basically, what it's saying here is the market is very uncertain about everything, and they're demanding that the United States pay a 15% return to hold a treasury note for 10 years. But lo and behold, only 5-6 years later, you only have to pay half that. The United States only has to pay half that. So what that means is basically the holders of the notes here doubled their value here. Now, like I said, it's not double because it's only half the time period left. 5 years has already passed. You have this theta to contend with, and you're not going to have 10 more years of bond payments. You don't get a pure double. But that's what's happening here. So the market is only demanding 7%. That means it's great. It's great for the United States. It's great for you issuing that bonds if year after year after year they're a little bit cheaper. But you can only go to zero. Can't go negative. Although I know the European banks try to go negative. It's odd if you go negative. You don't want to be in that situation, in my view. You don't want to pay people to lend money. So we've turned it around. And as I've said a couple times on recent shows, it would be wild if this is just now in sort of this period. We got to go back up and we got to retry this again. We got to retest whatever high the market might want for dollars. Doesn't mean the end of the dollar. Doesn't mean the end of U.S. supremacy or the U.S. military. But they're trying really hard to mess with it. I mean, when Trump has these jokers like Pete Hegseth, who's literally a couple weeks ago was a Fox News weekend host, and now he's running the Pentagon and sending out, I know a lot of people talk about this, but the guy is cosplaying as a real Pentagon leader, sending out these signal chat messages. Another one came out over the weekend. That's someone who thinks that they're running something in the military, but really they're getting the information from CENTCOM through the government, very, very secure comms and sending it out through signal. It's unbelievable. He's cosplaying a real leader. But as everybody should know by now, I know I'm sort of stating the obvious, but this is all about loyalty. This is all about mafia style. If Trump is testing who is purely loyal to his regime, and Hegseth is he's passing that test so far. So I think he could stay on. I really do. Could be wrong. I know everybody's saying he's going to get sacked, but I think he could. I said since the beginning he wasn't going to get fired. Why would he fire him now from the same signal chat? Roman, good morning. Slanitz, hello. So we're going through a lot of different yields here today. All right, so we got the 10-year. We looked at the change in the S&P. We looked at the 10-year, 2-year spread. So go back to gold. Gold. Let's take off the 10-year. Just changes in the S&P. Remember, we've never gone back to Mesopotamia. We've never gone back to the Stone Age here. Buy the dip, as always. But if you're a Malox person, just don't trade stocks. Obviously, if you want to swing trade, just buy these dips which are really low, and we're not there yet this cycle. Right? I'm not saying we get there, but we're not there. We're still at 6% year on year. Okay. All right, but gold is doing very well. Let's look at people should obviously have heard by now. Gold is doing very, very well compared to historical past decade trends, Peter Schiff trends. So let's go here. Gold fell with stocks during the GFC, then it rose with stocks. Okay. Gold had a good run here. I remember this was, going up from $200 an ounce to 600 or something here. We're getting to it, Roman. This is I think the point. I like this question. If you retired tomorrow, where would you store your money to balance preservation of capital versus growth that at least matches inflation pressures? That pretty much sums it up. For me, it's still Bitcoin. It's still Bitcoin, and we haven't got there yet, but we're about to. So again, gold is actually it's less reliable. That's the funny thing. You still would have a good return. You look at the slope of the trend line from gold since 1971 to today. It's actually something like 5-6%. If you picked the lowest point, that is $35 an ounce, to now, you'd get higher. You'd get something like 7-8%. But that's a cherry pick. I like doing the slope of the trend. The slope of the trend is 5-6% still. Anyway, look at how, you can have great, this is like the S&P never gave you this, but then you had to wait a long time to break even. I can't remember when it passed the $800 an ounce level somewhere here, post GFC gold. And then it went down 2000, after 2011, it went way down. Look at that dip, 28% in gold. Complete opposite of the movement of stocks. Again, opposite of the movement of stocks here. And now they're going together. But it does seem, if gold gives you that inflation or that market protection, this is a little bit better than bonds even, right? Of moving in the inverse. Okay, so you can see it here, inverse, inverse, inverse. To the bad, to the downside. Here it was actually correlated. Just not as big of a fall. It was correlated though. Fell. They both fell. And they both rose. So it's not a science. You never know. But if I had to project, yeah, I do think this diversion intensifies. Something like this, but the opposite, right? So gold goes up, markets go down. It seems that way. It seems. Thank you, Roman. I like that comment. All fine. All fine. Whenever anybody tunes in, it's all good for me. Okay, so now Bitcoin. This is just fun. Obviously, as everybody knows, Bitcoin went from nothing in 2009 to, now 90,000 today, over 90,000. I think it's still over 90,000. Huge little burst in the last couple days, by the way. Great strength. And yeah, 94,000 as of recording right now. So this shows some inverse correlation to the markets as well, and actually correlated with gold. But because it's so crazy, I'm not limiting the chart, whatever. Let's just put Bitcoin just for the fun of it. Right-hand axis, starting in, my pricing action starts in 2010. Here we go. It's always fun. So obviously, Peter Schiff just cannot compete with these trends. If you bought in 2011, even just from, this is just trailing 12 month, this isn't compound or anything, but if you bought in 2011, 188,000% from June 2010, just impossible to compete with. So what I'll have to do, unfortunately, is zoom in to the point where we don't deal with these crazy percentages, and that comes really after the 2013 spike. Let's go here. I think after, still dominating. Everything is just even 2013, 8,000%, nothing like gold. Stocks would give us anything like that. 1,000 here. Actually, shoot. Did I not test this? We might have to only go till today, actually, to see a comparison. Yeah, so still no return during the 2017 boom. stocks, gold, bonds. So this is on a different axis, so you can see it, but still, the yield on the 10 year is giving you 2%, while Bitcoin is giving you 2,000%. Let's take the 10 year off. Nothing compares. I actually need a third axis for the Bitcoins. All right, so really we have to go from this point. It should normalize a little bit more. Okay, it's a little bit better. Just have to look at the tooltip mostly. All right, so this was our Peter Zeihan moment on Joe Rogan. $16,000 overvalued at $17,000 overvalued. Bitcoin's about $16,000 per Bitcoin. All right, this is down from the 60,000 high. You know, you had the FTX debacle, everything here. But then it's on its way up. All right, this is just rolling trailing 12-month returns. Okay, so yes, you gotta struggle through some really bad bears. You know, negative 66% here, and let's just really quickly go back and take Bitcoin off. We never had that, right? 1974 down 36%. Here was still only 40, right? 48% year on year. I'm not an intraday guy. These are all year on year numbers. So 48% is the worst you would have with stocks and gold. Gold's even better. Bitcoin would go to 70, you know, what was it, 77? 77. So you got to struggle through that. I mean, you can play it, you can sell at the top, you can hodl and buy more at the bottom. Never financial advice. You got these Bart Simpson moves here. You got the big bumps and the big drops. It's a Maalox asset still, but it's getting adopted. And look at that. Even just this last year, a year ago, 238% return. Gold got you 19%. And gold was starting its rise last year at this time. Stocks 33%. This was an interesting fall, right? Had the Trump bump, really elevated here, you know, went over 100,000 and fell to the lows in the 60s, 70s, 70,000s. Did it hit the 60s? I don't even remember. Sorry. No, 70s. Only 70s. So the question will be, and this is the question we need to answer, right? Everybody's been asking this. How correlated is Bitcoin in a down stock market? This might be the first time we see it. And so far, both Bitcoin and gold are reacting much better in a down market. Okay, so the stock market is still not negative. It's only 6% year on year. It went negative around Liberation Day. All right, it went negative 3% year on year, but it recovered. 6% year on year for stocks. Gold, huge for gold, 43% up. But Bitcoin as well is right there. It's right there. Peter Schiff can't stand this. He just can't stand it. But I think it would be very interesting, and it would be completely expected, is if the markets, you know, assuming the chaos with the Trump administration continues, he acts like he's doing deals, but he just harms confidence in the United States dollar, everything else. I see no reason why Bitcoin and gold can't outperform stocks. And I obviously absolutely see Bitcoin well outperforming gold. I mean, it already has here. And think about this. These are just rolling on trailing 12-month returns. Okay, so if you put them together, right? remember my list here. You put them together. It's easier on trading view. You've got gold, Bitcoin, and stocks. Okay, so gold's actually pretty consistently better than Bitcoin actually in the last year. I wish this was a more of a midterm. Obviously, 5 years would just destroy it. We destroy it. Okay, so a long enough time frame, you just destroy the other markets. Gold and S&P about the same. Bitcoin, 1,000%. So, what do you guys think about this? Also, we can talk about tops, right? Every local high has been lower, right? From let's catch the 2013. Yeah, so the 2013 was obviously huge, 8,000%, 8,800% in a year. 2013 top, and there was actually two tops. Remember, in 2013 we went to $250 down to $60 to $1,300. Well lower, but still 2,300% in 2017, and that trailing 12 months was 1,000% here. Do you think this next top, which I think is coming, I think we're well en route to establishing it, do you think that it's going to be 1,000% or less than that? I did not hear Peter will be giving a speech at the May Bitcoin conference to warn people against Bitcoin. I mean, it's par for the course for him. Which Bitcoin conference? Is that North American or? It's probably then you're talking like the Nashville one or whatever, beat the main Bitcoin, BTC, Bitcoin magazine. It's a great asset. I just can't express it enough. I think we're so lucky to have this asset. Not just because of the returns, obviously they're amazing, but with what you can do with it. And theoretically, we have a U.S. admin who's going to buy more for the U.S. government. That's a tailwind. That's a tailwind for the asset. He's putting a headwind on every other market. But even if we didn't have this tailwind, they can't control it. They can't control the market. It's a worldwide market. Both gold and Bitcoin here, it's not exactly United States markets, mostly priced in dollars, but not exactly United States markets. Worldwide markets. And it still just dominates. Yes, it will well underperform in the dips. You got to be careful if you're relying on it for, a mortgage payment or something. Another thing I've also often wondered about is if we had this extreme, like I don't think it's the end of the dollar. Famous last words, right? But I don't think so. Still such a, hundreds of trillions of dollars. Worldwide, we have foreign entities invested in some 37 trillion, 34 trillion of U.S. stocks, bonds, and government bonds. It's just a huge, deep, liquid market. I don't necessarily see the end of it, even with Bitcoin being such a strong asset. Roman says the BTC conference in Vegas. Yeah, I think it's probably the main Bitcoin one. So the main one was in Nashville last year. Seems like the realization that Bitcoin is more liquid, mobile, and more programmable than gold kicked in once everyone needed a safe haven. And the thing is, people don't understand it yet. They still don't understand it. We got U.S. senators trying to educate on it, but the fact alone that this just dwarfs this chart, right? Like you can't even see anything. Fed balance sheet wouldn't matter. Here's another reason why I don't think it's all about money printing. It's about that power curve, right? It's about the power curve. This shows you right here, actually. Even if you go here, all right, we ignore the just first year of just insanity when we're this is like building up from a penny, building up from a penny on price. But if we just look at, say, from here, the 2013 boom, which is just insane, 8,800% returns. A lasting, sustainable asset. Yes, the returns aren't as high in percentage dollar terms, but you're dwarfing every other asset on this chart, which is the Fed balance sheet, the S&P 500, and gold itself. So it's 2,300 was the top in 2017, and here it was about 1,000. So a little bit less than 50%. Does that mean we're going to be at 400%, 500% year-on-year returns by the time this top builds in? I think perhaps. And again, the fact that I'm even speaking that way, that there's a top, I just do believe that that's going to repeat. Yes, could it be a decoupling and a hyper-Bitcoinization, everything? I don't think the world is ready for it, and I don't think that is a reflection of the power curve. So again, this is the point I wanted to drill home here. You can't even see the returns of Fed money printing. They don't even show up here. See that green a little bit right here? COVID. You can't see it on this chart because Bitcoin is not as correlated with those things. It will eventually more so be. But now it's just adoption. More so adoption. Much more so adoption. Here it was pure adoption and just pure insanity, right? But now it's still more adoption. Gold and Geo talking about gold being so shiny. Stuart and Geo. Yep. I think most investors will agree. You crave bottoms, and they're just much easier to play, right? I mean, if you want to trade. If you want to do options, do options. But let's go back to here. Remember, there were 20 to 22 cycles here over 75 years. That's a top every 3 years. So play the bottom, which is the same. I mean, you're going to have 20 or so bottoms every 75 years. Just look at when that deep discount occurs. And then either buy the index fund or whatever. But the amazing thing is Bitcoin still dwarfs these things. Just dwarfs it. There's no chance S&P can compete. There's no chance gold can compete. Really have to go in the very, very recent period to get somewhat analogous percentages, right? Because if we go out 5 years, we destroy the competitive assets. We've all made these mistakes, my friend. It's a very good point. Just trying to provide other indications of where the top may be. And it seems that to me, if we're, just very roughly again with this one, remember, 9,000 to 2,000. Okay, so that was this was like 25% of the prior. This was only half of the prior, roughly, a little bit less than half. So does the next trailing 12-month boom gain days, is it going to top out at? I just don't see it being more than this because this is part of the power curve. So let me put the power curve back on for you. Everybody's favorite. Hold on. Sleeping soundly is important. That's good. That's good. And aren't the I still don't understand with the USB Cs. Isn't the USB Cs and Lightning, are they different? Or not Lightning, Thunderbolt. Thunderbolt. There's Thunderbolt data connectors and USB C, but they look the same. We don't have to worry about which way they go in, but they look the same, but they have different functionality. Roman enjoyed. I enjoyed it as well. Very, very good. You guys bring the humor. Much needed on this channel. Living in Eastern Europe, as you know. Okay, here's the best one. Here's the... Oh, I'm so zoomed in, I can't... Here we go. Oh, this is a bit zoomed in. Let me zoom it out. Roman still needs help with the USB-C. Agreed. So it's all about, if we want to talk about the top, it's all about these bands. I still think you'll get to the 90th, which you had obviously every prior top. But if you look at just the past few, this tooltip is too big. There we go. It's 2017, 2021, double. Then we're moving up. And by the way, remember how long we were under here? Just like a week ago, 2 weeks ago. Remember, everybody was freaking out. Dipping below 80. And now this doesn't catch it, but we're actually at trend. We're above trend right now. This is, unfortunately, yesterday. I'm still getting my APIs redone, so this is a day delayed chart. Today is here, and we are above it. Oh no, sorry. What am I reading? No, we're not above the trend. Trend is 98. Trend is 98. We're at 94, so we're above all lines up to the trend. We're above number 6, which is like here. So definitely sleep soundly. And I think it's going back to 0.9 at least. What am I doing? There we go. So a 0.9 here, a 90th percentile move, is 2x the trend, 345,000 at the... I'm sorry, guys. I need more coffee myself there. 250,000. Double the trend at the end of the year. 250,000. I think it's totally possible we go up to the 95th percentile, whatever, 97th. But not long. Usually it's like a month. Try being Irish, Latvian, Norwegian, all hot-blooded. So we're probably looking at days here. When this Bitcoin bull gets roaring, we're going to look at days. Consider we've seen 236% already. I think we're going to look at days of 300, 400% year on year. And again, that's just going to destroy gold. It's certainly going to destroy stocks. That's all I had. today. If you guys want to see anything else, can always look at this as well. Remember, this is left-hand axis now. This is the spread of the 10 and the 2-year. It called recession, right? We didn't quite have it. I mean, you could count this as a recession, which we might be going into now, but it called it. Usually it's correct, but the spread went negative in 2023, July, and it didn't quite happen in the markets. Might happen now, but it's interesting. The spread is diverging, normalizing. Yeah. When are you guys going to figure that out in London? It's truly insane. In England. That might get you in jail in London, huh? Honestly, I don't look at it at all. XRP. Never traded it. I wish I, had bought it when it was like a penny or half a penny or whatever it was, but just didn't. It's a completely private chain, and yeah, they're going to try to run it through the U.S. system and whatever. A lot of Silicon Valley people behind that, as they are Sol, but I haven't traded it. They're never going to be, none of these XRP. I mean, if you look at the, some of these charts with first of all, the total mint that's supposed to be there, and then the mint that's controlled by the company, they're so out of whack. They're so huge in favor of the insiders that it just scares me a lot. It's like Trump coin, right? It's never going to trade it. There's a chart. There's another chart. Actually, do I have it? Where do I have it? It's on the red list. I can show it here, I think. Okay, so I got this list. There's an interesting one here. It's the hodler's balance. Actually, no, I don't want to compare. I just want to pull it up, which is what here? Or is it this one? No, it's this one. All right, so here's speak about insiders with Bitcoin. This has bottomed a little bit after the top. So the top was really basically the top. So just thinking about the Bitcoin price, right? It peaked in October, November 2021, and this bottomed. It was insiders, not insiders. This is just people that have held Bitcoin longer than a year. That's it. That's defining a hodler. So 10 million Bitcoins were in cold storage or not moving, basically, the UTXOs, for longer than a year. And when that started to move up again, that was the top. It's interesting. It has moved up. And this has actually scared a lot of people. They've been thinking, okay, maybe this is showed that 100K was the top. Never say never. Who knows for sure? But I don't think I just don't think that's in the cards for this one because we're still below the power curve. We're, you know, there's so many tailwinds from institutions, but basically, so you know, it's almost like the ideal. If you want to like swing trade Bitcoin, the ideal time is buy in as this hodler's balance starts to go down from its local top, and then sell when it starts to go back up. So the same thing happened here. See, people were really starting to sell into this higher Bitcoin price, sell in, and it actually extended it. Okay, so the top was here in December 2017. And then it still went down and bottomed out in May 2018. So it's not exactly, doesn't exactly correlate. This will be a good one for me to get on the regular chart, like my own chart engine to show you, but in a little bit more detail. But yeah, basically buy when this thing is going down, and then once it bottoms out and starts to go back up, it's usually time to sell. I know it's ticking up. It is ticking up here in the last year, but it could be something like this, right? Like it goes up a little bit and then goes back down. I don't think this is on a global trend back up just yet. It is a very insightful chart. So here's a good comment by Celinda. I agree. BTC whales can dump, and they do dump exactly in this type of a chart, but they don't control the network the way that Ripple whales control the network. There's just so much. It's like Trump coin to me. There's just so much direct manipulation of the chain and all these. There's a lot of stories about the manipulation with it, but I just don't follow it. I don't care that much. But for sure, I mean, these are whales dumping. Look, these are the long-term hodler balance at this time was 11, 12 million. Of course, the all-time circulating supply was building up, and whales started to dump as the price was going up to 20,000 per Bitcoin. Oh, sorry, this is already this is the 20. Price was going up to 60,000 per Bitcoin. 60,000. This is 60,000 time period. And then they accumulate after it starts to fall. I haven't heard. Stuart asked about the 200K price level. I haven't thought about it, heard about it. If you recall, there were a lot of big, like huge UTXOs that were coming in, like thousands of Bitcoins, worth hundreds of millions of dollars at like 95K on the way up last year, right? When we were getting, and those were obviously people that had a plan. They knew it was coming. They knew that eventually they just put a sell limit right at 100,000 or a little bit over 100,000 or a little bit under 100,000. I'm sure that will happen again at 200,000, but the 100K level was a very, very psychological one. I think it's much more like the 10,000 level, right? Like 20,000 was big, but we almost hit 20,000 like really quickly after 10,000, if you think about it. I suspect it will be the same. Because that was a plan that was in from these long-term whales and hodlers back from like 2010, 2011. It was just in their minds, like 100K Bitcoin is going to be, it's just going to be time to sell. And it's natural and normal, and it's going to continue to happen. It doesn't work that way with, ETH or Ripple or, nobody even knows the exact supply of ETH as we know. Possible. Roman thinks we couldn't even get to 200K. Possible. At the end of this year, 130K, your level, a little bit of the trend. This is only 1.1x the trend. See, I still think that's to me, that's too mild. It's totally possible. I mean, there's so many more tailwinds. There's so many more, grandma's talking about it and Thanksgiving. It's there. But I think we pull above a few of these bands, whether it's the 70th, 80th. My gut is still on 2x the trend. And even a little bit above it. Fancy ramen is always a good reward. I need to have just a simple chart of the trend lines. Let me check my trend lines if I have. I think I used to have one with the price and the market cap and the trend lines, so you can see both. It's a good question. Give me a second. Why is that taking so long? That's why I can't have these charts on the website. It's too much back end work for me. Every time to pull one up. No, don't need that. Okay, here's a market cap with the old stock to flow exponential, which is not going to happen. There's no chance we're on an exponential curve, which is a straight line on log scale. We're obviously on a power curve. If you go out till the end of the year on the power, this is not exactly projected coins time price, right? This is just running it on the power, but it's 3 trillion. And I think you could be higher than that. I think you get to 4 trillion, basically, to get to your question. Celinda. I think 3-4 trillion happens in market cap this run. That is crazy. It's interesting how the Anglo world, I guess, is rotating on their property bubbles, right? So it happened in America in 2008, and then in Canada, it took about 10 years. I think for Canada, they've been in a bubble for a long time now, whatever, 5-7 years, and then I don't know how the Australia uh, trend looks like, but clearly they're on a that's like seems like bubble territory. Do people uh, own mostly in Australia, Stuart? I presume they do. It's more of an owner's economy than a renter, or is it mixed? Yeah. Well, there's a lot of Ponzi's out there. This will give you comfort, though. There's flights now, right? Direct flights. Aren't there a couple? Roman says commute in. It's like a. How long is the flight? They still have those ridiculous Airbus. Qantas. Why is my Google so terrible? Approximate time from Sydney to London is 22 hours and 30 minutes. Yeah, and it's strange too. In the U.S., you have the the hedge funds taking over the housing market. That's a scary proposition to me because basically like turning into just the tech bro economy where nobody wants to fix their house or cut their grass. They just have a hedge fund own their house and they pay a you know something that equates to a mortgage payment. But it's like some either rent to own deal or just straight up rent for houses. There is a Schiller. I think they have the Schiller real estate. Trying to pull it up for you. Sorry for the dead time. Trying to pull up the U.S. real estate index. This doesn't seem right to me, but I guess it is. Here's the U.S. Case Schiller. He has this going well further back, but 2008 started to go down in 2007, actually 6 it looks like. Peak was 200, trough was 140. Now we're at 330. Inflation is a bugger. Yeah, I mean, this is a constant fear across any part in the Western world, and I guess in one sense, obviously, that's what the Trump admin is trying to do, but markets seem to disagree as far as the dollar goes. Because if we look at the Dixie, why isn't that coming up? I don't know. I understand this. I just unflagged it. I'll try to find it. Here's Australia housing credit. Whoops, is that? Sorry. I guess this is a base rate. You probably have a spread on this. So super cheap. It's gotten cheaper and cheaper. And then you have a spread on this, probably from the bank. Good one from Slonitz back to Bitcoin. I don't know the answer to this, but no time soon, in my opinion. At least 10 years, maybe 20. That's what I was trying to say earlier with, if you look at Bitcoin versus the rest of the markets, like, we're still way out of bounds as far as like normal market behavior, right? We can go big, way big here, thousands of percent per year, hundreds of percent per year, and then we go way, way down, like negative 75%, negative 75%. So the extremes are still huge for Bitcoin. And even if you just look at this chart, if you zoomed in even here, okay, now we're looking a little bit, you can actually see the lines of gold in the S&P, but we have this big, big delta. Big discount here, and then huge premium here. 10 times. It's just 10 times better than gold. And it's going to be that way when we go into the next boom. And I just don't see these booms as correlated to the markets or to money printing even. This is the point I keep trying to make. Like, this is not correlated to money print. This is correlated to adoption of the network. It also looks nice, right? Like, presumably, being disconnected from the power curve would mean you would connect to what naturally happens in markets, which is exponential. Well, if you just try to shoehorn the data on what Bitcoin has done so far with exponential, it doesn't make any sense. Like it says we'd be at $130 trillion market. All right, sorry, it's too far out, but you get the point. By the end of this year, it says we're going to have a $21 trillion market cap if we were on an exponential trend. It's not happening. It's just not happening. There's just no way. And that tells me that it's not an exponential curve. And it's certainly not an exponential curve that would reflect Bitcoin's current growth. Maybe in 10, 20 years, it would turn into an exponential curve that would be something more like, what the S&P does, or which, like I said, is 7 to 9% a year. But I don't actually see that for a long time. I think the fact that this power curve looks so nice, it's the exponential. If you go out, till the end of the decade, it says it's a $250 Bitcoin market cap, 1,000 trillion. Sorry, 100. Yeah, 1,000 trillion. 1,000 trillion. It says it's a $250 market cap right here. It's not happening. No, I think that's totally right. I mean, it's the bridge. Electricity is the bridge to the Bitcoin network. It's the analog bridge. So imagine you could programmatically extract gold at the rate of electricity production. Now, electricity production is also exponential, just like GDP, gold growth, stock market. And if you would compare the Bitcoin market cap or hash rate to those electricity markets, the market cap or the hash rate would dominate. It would squish into a power curve for any of these, which again tells me that we're on a power curve. Let me pull up another one for you. Yeah. So the question here, you heard me mention 100 years. That's on the growth rate. So right now, this is a 45% slope of this curve. It's 45% per year, moving to 42% per year by the end of the year. Even though this slope looks really small on log scale, first of all, notice that the dollar amount increases, right? Because it's so small and it's just growing. Like the dollar amount, let me say that again. The dollar amount even per day is growing. Okay, so that it still is exponential growth. It's just the rate of that exponential growth is not as fast as exponential growth, which would be here, which is just insane. It's not going to do that. But even if you know that you grant that it's not going exponential, but you want to say, okay, our rate of growth is declining. When does it hit 10%, which is the rough S&P with dividends? When does it hit 10% per year? That takes 100 years. So we're still growing faster than 10% a year all the way out to here, 2050, and another 50 years, and another some time. It gets to a $250 market cap by 2050. And the exponential growth would get to a $250 market cap by 2030. So just two different curves. If eventually we do get to an exponential curve that matches the S&P, for example, a 10% curve, again, that would take 100 years to do. So I'm not saying that's how it's going to be. I think probably two halvings from now, sometime like 2032 or something, we get to a serious situation where it's like, all right, enough of this fiat madness. Like the United States government is going to demand more Bitcoin. You're going to have to pay your taxes in Bitcoin, maybe, or a Bitcoin denominated taxes. It could be paid in dollars, but it could maybe be denominated in Bitcoin even. Who knows? I don't know the answer to it, but the curve itself is a long time, 100 years. How that translates into dollars and the world accepting it, it could be much sooner. And then we could ask ourselves, okay, what world are we living in? Are we on a Bitcoin standard? But if we look at this as network growth, this is how the curve looks. I have not, to be honest. I don't use it as much. The trading view, that is. I think some people have done it. Giovanni has been trying to do some trading things with TradingView. I'm just too immersed in my spreadsheets to give it time to worry about it. The thing is, TradingView is based on, I'm not sure they completely, they might have it. I'll search right now. Maybe they have it. But TradingView is based on dates on the x-axis, and this is not dates. This is numbers, actually. It's number of days. So here's day 0, or day 1, actually, January 3rd, 2009. And here is like getting close to day 6,000. So you just have to overlay the date axis. It's not a problem, but I do think TradingView is not set up for regressions exactly like that. Someone might have figured it out. Bitcoin. I'm just seeing some shit coins. Power. I haven't looked at Bitcoin dominance in a while. It's a possible indicator of a top. Possible. No, I mean, I'm sure people would like it, Stuart. If I could do it, if I can figure it out, or someone can help me, maybe we can do it. But it's just easy. It's just easy enough to me to do all this stuff in my spreadsheets and show videos of it. So here's where Litecoin started to gain traction. It's actually more here, away from the little 99%. Then Ethereum more here. But yeah, we had, actually it was here. December top was not a top in the dominance. And neither was the, yeah, that makes sense, right? So when all the shit coins are pumping, the dominance is lower, and the lower to the dominance is usually kind of a top, and then people risk off from shit coins and get back into Bitcoin at the bottom of the market. But it's hard to know with this index, right? Because the liquidity of so many of these market caps of these shit coins is very suspect. But it is an interesting trend, actually. Here, it's going up when usually when you would run into a bull, you'd be going down. It's a good one. I was just in London on Peter McCormick's show. I was using my Wise card. I guess I shouldn't have said that, doxing an account, but TransferWise for shit fiat coins is not a bad service. Yeah, Cronus mentions, good point. So let me see if I can find it, pull it up. The rainbow chart is indeed a power. What's the ticker? Is it just like a regular indicator that I can pull up? I'm kind of amateur actually in TradingView. I'm searching Bitcoin Rainbow Wave. Or do I have to run that indicator on the Bitcoin chart? Is that how it works? Let me launch. All indicators. Yeah, okay, I see it now. So launch. This is interesting. It's kind of like a short. This is not a live chart. This stopped in March, but there's a logarithmic. There's just so much going on with TradingView too. It's like it really is mad scientist stuff to me. Let me try to back this out so I can. What in the world? Okay, so here's an interesting one. This is the logarithmic regression. This is a regression, which is true. Bitcoin's falling away from the logarithmic. Logarithm is too fast. And it says it's the rainbow wave is here. It's kind of like a sine curve. Yeah, RV. Yeah, Desmos is good, obviously, for more mathematical logs. It's not. I really think it has to just do with the way that the software is set up, because everything is based on all this Fibonacci stuff, all the moving averages and stuff is based on. Oh yeah, okay. So this is actually kind of like mine. I'm talking about the rainbows here, not the sine curve, which is interesting, I guess, in a short term. But God, how do I turn this? I'm like a JV here with this. How do I turn off the ones that I even have on at the moment? Anyway, forget the log one. This does look like mine, right? I'm talking about this blank spot. Okay, so this is projecting out. This is correct. So the script works. They're translating the days into the dates into number of days since the Genesis block. If you go back to my, let me find it for you. All right. So again, it's really hard to see, but looks like the trend line is the green line. In this case, we're above trend, it seems. everybody's got a little bit of a different way to look at it. But here, the way he projects it out beyond is different than the history, which is kind of like how I do it with my with this. But again, I don't know how they make their bands. The reason mine looks wobbly here and not smooth and nice is because I'm basing it on the multiples. Okay. Oops, let me take this off. All right, so it's all about the multiple of the curve at the time. So obviously, back here, the power curve was faster. It was the black line as it was growing was faster. And that's how you get this. But the beautiful thing, as I've said often, is it's from about here where it starts to look a lot like the future. Take the tooltip off. It looks pretty good here. Like it the past as it's evolving is actually includes all data. And it looks like it just evolves really nice into what we suspect, the future projection will be. Yeah, thanks guys, helping me out with all the TradingView stuff. Yes, I could, Salon and Zach, ask GPT to write the code. I could. I'll get there. There's a lot of different things I want to try to get done here, but TradingView is a great tool. The guys definitely know what they're doing. Yeah, I mean, generally this is probably the idea. Obviously, no one can predict the exact tops, but if you can see where it's getting hot in the orange bands, right? So 7, 8, 9. Let me just make this easier on us. Okay. There we go. This is everything above trend, right? And again, here, even though this is like way above trend, the trend line itself was higher at this point, right? Okay, so let's look at this. Every top was at least getting above the 90th, although it is very true that here we really struggled to do that. And now we're struggling even to get back up above trend. But I still think I do think you get to the 90th. But yeah, I mean, if you just imagine a basket and say you had Aussie dollars and Bitcoin, every time you're above the black line, even you could sell some Bitcoin, have more Aussie dollars. Every time you're below the black line, sell some Aussie dollars, have more Bitcoin, and you should grow. You should accrete the value of the basket. But trading it on an intraday or even a swing trade, it's very difficult, I think. Yeah. Thanks, Stuart. It's frustrating for me. I don't know. I got to figure it out because there's like a lot of different directions I want to go. When I start to do it, then my mind races to put a lot of different things. And then I think, oh, I got to cover some stocks and bonds, and I got to go back to this chart. And it's just easier for me at the end of the day. It's like every day make some charts or update some charts. It's just easier for me to do the videos. And plus, I'm a little bit lazy. I don't want to manage a subscription. How many newsletter writers were saying the world was over? I was reading newsletter writers all through this period, and they were just telling me gold was going to infinity. The world was going to zero. What happened was gold eventually fell 27%. Obviously, I was buying Bitcoin a little bit here too. Not as early as here, unfortunately. I heard about it in 2011, but wasn't buying. It's just funny. It's funny to think about how much money one can spend on newsletters. Well, they spend half of the newsletter just telling you the world is going to shit. All the meanwhile, the S&P is rising and gold is falling. I just think we're lucky. Like it is the nice thing about even doing these charts and then just being able to throw this on and be like, well, whoops. Yeah, still, I mean, you just dwarf everything else. And then if we zoom in here, we're still dwarfing. Yeah, we're exceeding to the downside for sure. But we're more than making up for it on the upside. And just to beat the dead horse, I do think that this trend is. I have more faith in this trend line actually than anything else. Even the monetary based stuff I do, all the talk of inflation, all the talk of tariffs. This is to me the big picture. And just to look at the trend, I got to wrap it up, guys. But this is a nice little bump, right? But so from yesterday, from yesterday till today, the trend yesterday was 98,719. Today it's 98,815. I got to do math in my head now. What's that? $94. I'm so stupid. I can't even do math. 911. 94? 94, but it's going to go up to, to well over 100. So here it's like $95 a day. The point is that even though the rate of the growth curve is falling and it doesn't seem that amazing, it doesn't seem like an exponential trend like this, the dollar value is still increasing. You're still going to increase better in dollar values than, gold. Because, here you're going up. Here you're going up 1,000, well, 800. You're going to start to go up $800, $900 a day next year. Next year. Just the rate, just the daily rate of the curve itself should give you awesome comfort. Just the curve itself. So here we're under $100, and we're going to be under $100 only for a few more days. Yeah, here's 96. $96 a day. You go out to the start of next year, which I can't figure out. And it's sorry, forgive me. 130. When does it get to 1,000? Not for a while. Anyway, that's a lot. That's too much looking at the daily rates. The point is the dollar value is still increasing quite a bit every day. Even though we're under 100 here, it's going to be a couple hundred here, and yeah, still a couple hundred. A couple hundred for a while, but it should give you confidence. A couple $100 a day at an increasing rate. Yeah. Yeah, just like with stocks. I mean, when the market tanks, like I said, it's happened 20 times, 30 times in the last 75 years, 25 times, 3 times. Once every 3 years, you're in a cycle. You just expect it, and you hope for the bear markets. And it's almost like this is another thing of why people say the printing money just really ruins the cycles. Is it does ruin the cycle. Look, we had from the GFC until 2019, we had a lot of Fed money printing, QE123, and we just really didn't have a nice bear cycle again to flush everything out. We just had this zombification. This is Japan style, right? Gold went down. All the gold bugs, all the newsletters scammed their readers, but stock market, okay, it did go down in this period in 2015, 2016, but other than that, it was a very dampened cycle. It's normal to have bulls and bears and stick with the asset that increases a couple $100 a day on the trend line. All right, guys, I got to sign off. Going to be traveling next week, but I'll try to get a couple more streams in this week. And I appreciate you all watching. Stuart, good evening to you. Roman, good morning to you still. It's already afternoon here in the Baltics. Salonits, everyone, thank you for your comments today. Always happy to respond to them, and I'm enjoying this chatting with you guys. Thanks a lot.